If you want to make a living by day trading, scalping is one of the skills you will have to master. Scalping is not difficult if you understand the market, identify the high probability setups, develop your own strategy, and stick to it. In this video, I'm going to show you everything you need to know about scalping. So let's get started. I will cover the following topics. Number 1, the scalping basics. I will show you what to trade, when to trade, and also the important rules for scalping. Number 2, the scalping strategies. Each strategy contains 4 parts. The most important part is the setup, and then I will also go through the entry, stop, and the profit target. Number 3, in the last part, I'm going to use the Bitcoin for example to show you how to do the scalping in the live chart. What is scalping? So simply to say, scalping is to take small profit in fast-moving and trending market. So here, you want to remember the 2 keywords, fast-moving and trending. These are the characteristics for a strong market. Basically, we classify the market into 2 categories, strong market and a weak market. And you want to scalp only in the strong market. What's the difference between them? First, for the strong market, it is always trending. You can see clear direction. However, in the weak market, it is normally in trading range. Second, in the strong market, there are a lot of high probability trades. But in the weak market, normally you will get stop out. Third, you can take quick profit in the strong market, but in the weak market, your target might not be reached. Now let's have a look at the 2 examples for the strong market and the weak market. First, the chart on the left. We can see very clearly that there are consecutive bull bars going up here, and also at the same time, there's less overlap of the bars next to each other. These 2 are the signs for the strong market. For the strong market, when it comes with the higher high, you wait for the pullback and trade the pullback. Then you wait for the signal bar, here it comes, and then you scalp. You can see that definitely you can get a profit. So in the strong market, you can see the leg up, pullback, and up. It's very clear. On the contrary, in the weak market, first we will see that there are a lot of overlaps among the bars next to each other, and also at the same time, the leg is not that clear. If you use the same strategy to wait for the lower high, and then wait for the pullback to trade the pullback, then these 2 bear bars can serve as the signal bar. However, when you put your trade through, you can see that you put your stop at the top of the pullback. In the end, the market didn't go down enough to hit your profit target. However, it gives you a stop out. For more information to identify the strong market and the weak market, I have another video which is the candlesticks in day trading. It is a complete course for beginner day traders, so you can have a look at that video for more details. What financial instruments can you trade on for scalping? Basically everything. So you can scalp on stocks, crypto, futures, and also currencies. However, you want to know the details of each of the financial instruments before you start the trading. Let's take this ESE Mini S&P 500 futures for example. In the table, there are 2 things you need to pay attention to. The first thing is the contract unit, which is $50 times the index level. If the index right now is at 4,000, that means you need $50 times 4,000, which is 200K for starting the trading. However, your broker will give you a margin, let's say 5%. That means you need 10,000 US dollars to be able to trade 1 contract. Another thing is the minimum price fluctuation. That means if the market moves up by 1 tick, which is 0.5 index points, which is equivalent to 12.5 US dollars. So normally for beginner traders, 2 points for the ESE Mini is the daily target. The next question is when to trade. Some of the financial instruments can be traded around the clock. Like the currencies and the futures, they can be traded almost 24 hours from Monday to Friday, and for the Bitcoins, it can be traded 24/7. However, you cannot trade that long. So you want to find out when the market is the strongest and trade accordingly. There are a few options. First, we can trade during the exchange trading hours. Here's a table listing all the major exchange trading hours here. If we take New York time for example, first in the morning we have the London market, and then we have the New York market. In the evening we have Sydney and also Tokyo. However, most of the volumes will be happening in the New York market opening. Even during the exchange trading hours, the market is not always very strong. So you want to find out when the volume is increasing and then trade accordingly. Here's an hourly trading chart for 3 consecutive days. At the bottom, you can see the volumes. You want to trade in the hours that the volume is the highest. There is a special situation here. It is the economic event. Basically, there are examples in the table. You can see that at 2 p.m., there is an interest rate decision. This economic event will impact the US stock market or anything that's related to the US dollars. So on that day, before 2 p.m., you don't want to trade because the market will be waiting for the financial result release. If you trade before that, you could get stop out. Right after the financial result release at 2 p.m., you will see the market moves greatly. If you can capture the trend for scalping or even for swing, you're going to make a fortune. Next, what chart can you trade for scalping? Here's the table showing all the chart types. We have the second, minute, hour, or even tick and volume. However, it is recommended that the beginner day traders are using 5 minutes, 10 minutes, and 15-minute chart because you need time to make your decision whether to pull your trigger. And also on the economic event release, you can use 30 seconds or 1 minute to capture the first minute market movement. For one financial instrument, what time frame to trade on? So here's our examples. On the left, we have the 5-minute chart, and on the right, we have the 15-minute chart. You can check on the chart that here there's overlap between the bars for the 5-minute chart. However, on the 15-minute chart, it is clear. The same thing for the overlap here. It is not clear on 5-minute chart, but it is clear on 15-minute chart. So you can check each of the financial instruments until you see a clear chart. That is the time frame you want to trade on. A beginner may think that they want to trade lower time frame to lower their risk, like they're trading 1 minute or 2-minute charts. However, that is not the case. Basically, the position size will decide your risk. You can always reduce the position size to the level that you're comfortable with. Another way is to find out the alternative instruments. For example, the ES E-mini futures is too much for you, you can use SPY instead. For the Euro futures, you can use the currency Euro USD for alternatives. Let's move on to a very important topic, which is the risk-reward ratio. Here's the table showing all the possible scenarios. We can see that when the reward to risk is 1-to-1, we need 50% winning ratio to break even. That means for any trades that give you over 50% of win rates, we can make profit. However, if you increase your risk, for example, 2 risk against 1 reward, that means you need to win 67% of the time to break even. On the other side, if you increase your reward, you need only 33% win ratio to break even. For beginner day traders, it is not recommended to use the risk larger than the reward. And then it is preferred to use the reward to risk between 1-to-1 and 2-to-1. For the reward larger than 2-to-1, like the 2.5-to-1 or 3-to-1, they're more for swings because most of the time the market will come back for pullback. Here are some rules for scalping that you want to keep in mind. First, always trade with the trend. Beginners tend to trade against the trend because they didn't see the big picture for the whole day. Here's an example. So basically, when you see this down leg here, the beginner might wait for the pullback and then trade downward. For example, if they see there's a bear bar here, or the bear bar here, or the bear bar here, they want to go short. However, the big picture is this is the first leg up, and then this is the pullback, and then it goes up again. So for the correct trading, we need to wait for the good signal bar to go long here, here, and also here. The second rule for scalping is let the bars finish before you make any decisions. This is because your study is based on the finished bars. And also, if you make a decision to enter the market when the bar is still developing, when the bar finishes, you could regret. Here's an example. When the bar is still developing, it is a very strong trend bar. And then if you enter the market goes up as expected. However, in the last few seconds or even in the last few minutes of a 5-minute bar, it could end up something like this with a big tail at the very top. So this means a strong resistance. So the next bar could be a bear bar to hit your stop. The third rule for the scalping is to survive the pullback. So basically, what if the market doesn't go your way right after you enter the trade? There are two scenarios. If the setup is still valid, you need to hold your position. If the setup changes, you need to exit the position right away. Here's an example. The market goes down, and then your strategy allows you to wait for the pullback, which is this bull bar, and then you wait for a signal bar, which is this bear bar, and then enter the market at the bottom of this bear bar. And you put your stop at the top of the pullback here. However, the market didn't go down as you expected right away. Instead, it pulls back. So at this time, if you are afraid of being stopped out and exit your position, you will regret, because the market goes up and then it is 2 ticks below your stop here, and then the market resumes downtrend. Right now, you are having a losing trade instead of a winning trade. The fourth rule for scalping is pull the trigger whenever the setup is ready. This is because some beginner traders is afraid to trade again when they have stop outs. However, you should understand trading is a game of probability. There must be some losing trades. And also you need to control your emotions. You don't want to be over happy, upset, or angry. Any emotion could lead to losing trades. In the end, if you have a few stop outs in a row, you really need to stop trading because there must be something wrong, either your strategy or maybe because of your emotions. Here's an example. We have a down leg, and then you're waiting for the pullback, which is this bull bar, and then here comes the signal bar, this bear bar, and you enter the market with a stop at the top of the pullback. However, you can see that the market goes back to stop you out. A few bars later, we can see this bull bar with a big tail at the top. That means the market could resume the downward. And then when you see this signal bar, you should be able to pull your trigger again to trade downward. And then in the end, you can see from the chart, you never get stop out, and then the market comes with another signal bar here. You can trade again to add up your position. Then the market goes down. So this signal bar and this signal bar, you should take the chances to put your position there to enter the market. Otherwise, you're going to end up with a one losing trade. Study of the historical charts and the daily homework are very important. Here's an example. You want to have a table with the statistics on the winning and losing trades for each of the setups here. You want to understand the win ratio for each of them and then how many P&L they can give you so you can trade accordingly. Another thing is that you want to develop your own strategies rather than using others directly, because if you use others, that means you don't have a good understanding of what the strategy is, and then you will end up losing. The next is you want to learn from your losing trades, even though looking at the losing trades is going to hurt because you're losing money. However, you should really understand why you're losing, whether it is because of your strategy or because you didn't control your emotion. Otherwise, you're going to have the same losing trade again and again. The last part for the scalping basics is to trade paper account until you're profitable. This is because you need the paper account to test your strategy. And also in the real trading, you need to learn how to pull your trigger to trade different orders. And then you can move to the live account with a small position if you feel comfortable. Lastly, so whenever you see there's any issue with your live account trading, you need to move back to paper account to avoid further losses. Now let's move on to the most exciting part, the scalping strategies. So for any strategy, there should be at least 4 parts: the setup, the entry, the stop, and the profit target. And among the 4 parts, setup accounts 90% of the success. So if your setup is good with a high probability, even if you don't manage your trade well, you won't get big loss, or you can end up with a small profit. However, if your setup is with very low probability, even if you manage your trade well, you could have more losses. There are a lot of tools that you can use for setup. You can use Trendline, support resistance, EMA, MACD, RSI, Bollinger Band, Fibonacci retracement, pivots, volume, and ATR. However, among all the tools, Trendline and support resistance are more reliable than the others. For the rest, indicators, it is better that you use them combining with either Trendline or support. There are a lot of setups that can lead to good scalping opportunities. However, in this video, I will introduce only the 3 major ones. The first one is the event breakout. Second one, trendline breakout. The third one, trendline support and resistance. Let's first talk about the event breakout. This is the GBP CAD 5-minute chart, and on that day, there's an unemployment rate release. And you can see there's a huge bear trend bar at the moment when the result is released. And also it's leading to a second leg down. What we can do is, beforehand, we want to know what date and time the event is going to be released, and then we want to study the historical chart to see which financial instrument is impacted by this event. And at the moment of the result release, we can either use 30-second chart or 1-minute chart to capture the first 5 minutes market movement, and after the first 5 minutes, we can go back to the 5-minute chart. The second setup is the trendline breakout. So basically, the market first moves between 2 lines, and then suddenly it breaks out either side with consecutive either bull bars or bear bars. And then there's a good opportunity when it pulls back, and then it's always leading to the second leg, and we can do a measure move. So we're waiting for the pullback for entry. The third setup is the trendline support and resistance. Normally, the market will move between 2 trend lines, and then when it touches either side of the trend line for the third time, there's a good trading opportunity. However, we want to trade with the trend rather than against the trend. And we can set the target to be other side of the trend line, or we can use risk-reward ratios. There are also other setups which will lead high probability trading opportunities. For example, the stairs pattern and also the trapezoid. You can search my channel for those 2 videos for more details. In terms of the entry, there are a few types of orders that you can use. The first one is the stop order. Basically, when you see the signal bar, you put your stop order at either top or bottom of the signal bar to enter the market. The second is you can use the market order. So you put the market order upon the close of the signal bar. And third is the limit order. You can put the order at the top or bottom of the pullback crossing the trend line. So I strongly recommend the beginners to use the stop order, because when you see the signal bar, which will increase the probability that the market will go to the direction that you are expecting. And also, with a lot of brokers, you can specify the stop order and the limit order attaching to an entry. So whenever either the stop order or the limit order is hit, the other order will be cancelled automatically. Now let me use an example to show you how to use different orders for entry. Let's use this trendline support and resistance setup. So basically, this is the third time that the market touches the trend line. So we're waiting for a signal bar, and then this bear bar can serve as a signal bar. So if you are using the stop order, you want to put it at the bottom of the bear bar here, so just one tick below the low of this bear bar. If you are using the market order, so when this bar is finishing, so you can hit the market order button to enter at the close of the bear bar here. The third is the limit order. So basically, you want to draw a line which is the intersection of the trend line here and also with the bar. So you put your limit order here. However, the issue is that your limit order might not be hit. There are two things about entry that I would like to bring up. The first thing is, in a fast-moving market, you could get slippage. For example, if you are trading the event breakout and then you put your order, the stop order, on top of a bull bar. However, when the market moves up, you're not going to get hit at the level. Rather, you're going to get entered at a higher level. So this is called slippage. So for the slippage, there's no good way to deal with it. And you shouldn't be changing your plan, especially the profit target, though this slippage doesn't happen a lot. Second, anytime, do not force the market to enter a trade and do not trace a trade. So basically, if the setup is not ready, don't enter. Do not force the market to give you a trade. And also, if you miss the opportunity to enter a trade, do not trace the trade, just let it go. Now let's move to the stop. So there are a few ways for you to put your stop. The first is you can use the current pullback. So in this case, you're adding your stop at the one tick above the pullback here. However, if the market doesn't go down immediately and then it goes back to test your pullback, it could give you a stop out. The second is that you can put your stop halfway between the current pullback and the previous pullback. So in this way, you give more room to the market and at the same time, you're increasing your risk. The third way is you put at the top of the previous pullback. The reasoning behind is because the market, if it goes back to test your previous pullback and even go higher, that means the downtrend is over. There are two things about a stop. First is the protective stop and an actual stop. So basically, you can use the halfway stop and the previous pullback stop as the protective stop. So the good thing about this protective stop is you give more room for the market to develop. And also, the market could really go any direction. So in case it doesn't go your way, at least you have something to protect yourself. And when the market goes your way, you want to move your protective stop to your actual stop at the pullback immediately. And then you want to measure your reward based on the actual stop rather than the protective stop. The second thing is you want to have a close position button in your trading platform. So anytime you feel that something wrong with the market, you can close your position and cancel all the pending orders immediately to reduce your loss. Now let's move on to the last part of the strategy, taking the profit. So there are two ways that you can take the profit for scalping. The first way is you can use your reward and the risk ratio. So based on your study, you can use n times the risk as your reward. N should be between 1 and 2. So take this chart for example. Your entry will be one tick below the signal bar, which is this bear bar, and then your stop should be one tick above the pullback, which is here. So this is your risk. And then if you're taking the reward the same as your risk, you're gonna take profit at this level. And if you're taking 2 times the risk as your reward, you can take the profit at this level. The second scenario is that you can use the measure move. So the basic assumption is when the market goes down for the first leg, after the pullback, the market will go down the same distance as the first leg. So take this chart for example. If you assume this is the first leg, this is the pullback, so you measure the distance from the top of the first leg down to the bottom of the first leg. And then you measure again from the top of the pullback down. So here is your profit target. So in this case, you can see that there's a small pullback here. And then you can also treat this as like a swing. It really depends on how you understand this market. So if you're using the swing, you're going to take more profit than scalping. Now we are at the last part of the video. I'm going to use an example to show you how to apply scalping in the real life trading. Take this chart for example. Initially, the market is moving down between the two trend lines. What we are doing is to wait for the market to reach either side of the trend line and see whether it is going to break or it is going to reverse. So in this part, we can see the market reached the trend line here and then didn't respect it. Instead, it breaks it a little bit. However, at that time, we're not quite sure whether it is a break or it is a simply expanding of the range. Then we can see that there's a previous range high here, and then we want to draw a line at top of it. This is the resistance line. We want to see if the market reached that line, it's going to break or not for confirmation. Later on, we see this big bull bar breaking the top trend line and then reaches the resistance level. However, it respects it a little bit. We still need to wait for confirmation whether it is going to reverse or it is going to break. A few bars later, we can see there's another big bull bar breaking this resistance level and then going up. So at that time, we are very sure that the market is going up, and then this previous resistance level becomes the support level. After the market breaks the resistance level, it becomes the support right away. And then we are waiting for a good signal bar. So here comes the bull signal bar. Then we place our entry at top of the signal bar, one tick above it. And then we put our stop one tick below the pullback. And then here is our risk. We can take the profit between 1 and 2 risk as our profit target. So here is the 1 risk level and here is the 2 risk level. So you can see the market goes up until the 2 times the risk and then it pulls back. So that means there are other traders taking the profit using the same measurement like us. And then after a while, you can see this bull bar is very good trend bar that indicates there's a high probability that the market will go up again for another leg. So we need to prepare for another scalping opportunities. And then after the pullback, we see another very good bull bar which serves as the signal bar. And then we trade again using the same technique. We put our entry one tick above the top of this signal bar and the stop at the bottom of the signal bar. We can take 1 or 2 times of the risk as our reward. Again, you can see the market reacts here by pulling back. That means other traders in the market are doing the same profit taking at 2 times of the risk. After we finish the second trade, when it pulls back, we can see that this is clearly a stairs pattern. So basically, the body of all the bars are within a rectangle, and also the whole candlestick are within an outer rectangle. This is clearly a stairs pattern, which will give you a 90% of the probability that the market will go up again for another leg. However, we have already go through 1, 2, 3 legs. So this fourth leg, the probability won't be that high, and the profit target shouldn't be that much like the measure move of the second leg and the third leg. So to be cautious, we put our profit target as only 1 time of the risk. And you can see that if we use the same scalping technique, we're going to get a profit at 1 time of the risk here. And then the market pulls back. Again, other traders are taking profit using the same understanding of the market. To sum up, this is a very strong market with a very good trending. So we have 1, 2, 3 times of scalping opportunities. And you can also keep part of your position to swing to the end of the trend to take more profit. If you enjoyed my video, please don't forget to subscribe, like, and comment. You can also go to my channel for more videos. Thank you.